So what does it cost to refinance your property? Talking with us again from day one. How long is what's your project end date? How long do you foresee the renovations being?
What is your exit strategy, and do you have it clearly planned out?
We can structure the mortgage properly to make sure that you guys are having the lowest exit penalty possible.
What is up, YouTube? Matt McKeever here, and let's talk about what happens when you actually manage to pull off 100% financing. How do you go about taking that and refinancing it into a lower cost of debt? Well, that's what today's video is all about. So Josh and Ehren are going to dive deep into the subject matter. So let's just get into it. What is up, YouTube? Matt McKeever here, and we're back with the Findlay team. Hey, Josh and Ehren. And today we're going to be talking about what happens and how do you get out of that 100% financing. So if somehow you missed part one of this series, you absolutely need to jump back, check out that video. But essentially in the first video, we broke down how it is possible in Canada to actually finance 100% of your purchase price of a property.
Correct.
So that's not going to last forever though, right? Usually we're getting in at slightly higher costs of borrowing, things like that. So usually the average investor is going to want to refinance out. So how does that work, and what would you guys kind of share with the audience?
Sure. All right. So you guys are rockstar real estate investors. You've somehow navigated your way through 100% financing. You've got it done, and now you're sitting there with either a vendor take back and a mortgage or two mortgages, and you have to figure out how are you going to exit this specific situation. That is what we're going to talk about today. So initially what we wanted to do is we wanted to break down the different options for refinancing and how you guys are going to be able to do that. So Ehren, you want to start?
It's important to understand what loan to value lenders are refinancing at, because that's the amount of equity that you're going to need to have in your property at time to refinance. So if you're 100% financed, you're 100% leverage with zero equity in your property, you need to somehow create, to be safe, 25% equity in that property. That's going to be a refinance of 75% loan to value. So let's kind of go over some ways that we can increase the property value during your BRRRR strategy and your rehab time to kind of get that equity built into the property. So there are a few things that we can take a look at. Obviously, renovations to the property outside of just basic lipstick. Lipstick will work, but hopefully it's a little bit more in depth because you really need to build this equity into the property. So that's going to be structural changes, whether that's redoing the backyard, maybe putting in some new kitchens, some new hardware, anything that's going to bring some true value to the property outside of just painting walls and adding some small fixtures. Purchasing undervalued can be a good way to be able to increase value without really doing anything to the property. So one of the methods we talked about was if you can purchase undervalue and you use that, your purchase and sale is below what an appraisal is going to come in. Ideally, we're able to just use an appraisal a year later, a new appraisal, and hopefully, there was already 25% equity built in, and that's something that we can take a look at the time of purchase as well, too, to let you know how much equity potentially could already be in there, and the difference between what you're picking the property up at and what the actual appraised value is. So, that's something that we can take a look at right from the get-go, and that puts you in a really strong position right from the purchase to know you're going to have a really good chance of refinancing out.
So one of the other ways that is possible to change the value significantly is rezoning a property. I know it's a little bit out of maybe some people's wheelhouse, but the highest and best use case is what we're looking for a piece of property. So if, for example, the city changes zoning or the ability to zone a certain area to maybe mid-density or high-density residential property, and you own that piece of land or that piece of property, it would be in your best interest to take a look and see what maybe an acre of high-density residential land is going for in your city. I think you'd be blown away as to the value it would add even if you have a house on it. Because that value to you, maybe it's just a piece of land, but to a developer, to somebody who has the ability to make some sort of multifamily residential property, it could be a big ticket item that you're sleeping on. So taking a look at the rezoning to the highest and best use case is definitely a way to add a bunch of value to your piece of property.
Mm-hmm. And then even just on the more basic level, having that zoning to be able to convert from a single family home into a duplex or maybe some sort of multifamily triplex, building on those additions. I know we get a lot of duplex conversion type deals coming across our desk. That's a really strong way to be able to increase the property value. Going on the best case, if it's an income producing, you take a single income to a double income type property, you're going to see a large increase in value just through doing that type of conversion as well too. So that can be a really strong point to increase some value into the property. Another thing, kind of touching on that as well too, is obviously going in and maximizing the rent that you're able to do. Being able to go into a property and take it vacant and automatically rent it out on the max is obviously the most ideal circumstances, but not every time can we get a vacant property. But going off of how the appraisals work, and if we are using an income approach, if you're able to increase your income by or your rental income by 20%, that 20% in increase in income is going to have an effect on the evaluation of the property come time when the appraisal is done. So, it's more than just having an increase in cash flow. It's also going to come in handy when you come to have your appraisal at the time of refinance. So it can be a strong asset as well.
And I know we talked about this in part 1, but again, it's really critical as an investor that we've got a clear plan when we get into this asset, right? And I know for a lot of the investors watching my YouTube channel, the most common strategy a lot of us are going to be implementing is the BRRRR investment strategy, where we are looking to force appreciation into the property. And oftentimes that's by, like Josh was mentioning, trying to optimize the features that we're offering to our tenants. And as a byproduct of that, then we can charge significantly higher rents. And I know here in London, a lot of the properties we're buying, we're regularly increasing the rents, anywhere from the tune of 25 to 40% greater than what they were renting out for once we get a chance to go in, add that new kitchen, add that new flooring, repaint everything, touch up the bathroom. So this is a very replicatable business model that you can roll out.
Agreed. Yeah. So one of the kind of benefits of rent change as well is if you're into 5-plex or above, like an apartment building or something, and you purchase it privately because the debt service coverage ratio isn't where it needs to be, changing those rents and adding the gross or net operating income of the property and bringing it up will bring your debt service coverage ratio maybe into line with where an institutional lender would need it to be, like 1.1 to 1.2. And at that point, you're no longer paying interest-only payments, and you're moving into that institutional 3 or 4% money, where that's a sweet spot. That's where you want to be as an investor. So those small things that you can do to raise the value of the property have huge ramifications in the long run.
And just touching on that too, as much as it has a much more amplified effect on a larger multi-property, we still use debt service coverage sheets on a 1 to 2 unit property as well too, on A and B sides. So as much as it's important for the commercial, it can be just as important if you're looking to be able to refinance from a private into a B or a B into an A, to be able to optimize the rental income and your debt service coverage ratio. So also important for smaller unit properties as well too.
Last but not least is exit strategy. We spoke about it a ton. Probably most important part of refinancing or 100% refinancing is what is your exit strategy, and do you have it clearly planned out? So before you get into your property at 100% financing, what are your personal debt ratios? What does that look like? If you're going to hypothecate, your purchase that you're going to have, can we look in a year or two from now of what your plans are estimated and what you plan to do to the property? So if you plan on raising the value, or if you plan on raising the rent, what is that going to do, and what is that going to look like for you in a year or two when you want to refinance out? So personal debt ratios are going to be important for anything 4-plex and down, because you're qualifying based off of your own personal debt. So that's super important. The second is, will CMHC refinance me? So for commercial lenders or commercial investors who are purchasing multifamily residential property, if you're looking to refinance out and you want CMHC financing, there is a list.
It is the National Housing Act list.
Okay. If you're looking to refinance through CMHC financing, there's a official list that was released by the federal government that states that only CMHC can only refinance out of these specific verified lenders. So if you have a private loan and you want to refinance out, CMHC isn't going to do it. So you need to make sure that your debt service ratios or your debt service coverage ratios for your commercial building is within the guidelines of one of those institutional lenders to be able to get that type of financing.
Yeah, and it's definitely important if you are interested in that CMHC type refinancing, definitely reach out to us, because it's not common, but it is definitely possible. So we want to make sure that you're going to have the type of deal that will qualify beforehand, before trying to explore that option at the time of refinance, only to find out you went with a lender that they're not able to refinance out. So that's got to be kind of a day one type strategy. And we see that a lot more on the commercial and development stuff, where maybe they're going to pick up some sort of financing to get the construction done, and then have CMHC come out and take that out and provide them with a AAA mortgage or a better rate mortgage on the property. So that's definitely a day one strategy that we would have to talk to the investors about from the day of purchase to make sure everything's meeting accordingly to go forward with CMHC.
Do you want to get control of your financial life? Do you want to crush it in real estate with wholesaling? Do you want to join my full-time team of wholesalers like Mike or Shahir? Or what about Tyler? Or Diego? Or what about Amar? All right, and what do we do, boys?
We make offers, we buy fast. Never gonna miss a deal cause we pay cash. Offers, 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 deals, deals, deals. Tell us, Mr. Seller, what price do you feel? Cause we're Southwestern's biggest source of deals. Boom!
So if you guys want to crush it with wholesaling, you need to join my team. And down below, video description, there's all the links you need.
That's definitely a day one strategy that we would have to talk to the investors about from the day of purchase to make sure everything's meeting accordingly to go forward with CMHC.
Awesome. Anything else related to refinancing out of that 100% loan to purchase?
Yeah, I'd say, making sure we choose the correct rate. One of the things that you guys should make sure you're doing in your ARV numbers is making sure that you consider exit penalties as well too. So structuring a proper term and making sure, if it's going to be a short renovation and you're going to have everything done in 4 to 6 months, let's make sure it's a 1-year term to be able to, minimize the risk of having to go with an interest rate differential. At least we're going to be dealing with a 3-month interest penalty. Whereas, if you're with a 5-year term and you get the property renovated in 5 to 6 months, and we can refinance you out in the 10 to 12-month period, like we said, you're probably going to be paying somewhere between $15,000 to $20,000 in exit penalty fees, and well, there goes a lot of the capital and cash flow you were just earning, and we're about to get on the refinance. So, talking with us again from day one. How long is what's your project end date? How long do you foresee the renovations being? We can structure the mortgage properly to make sure that you guys are having the lowest exit penalty possible. One other thing to kind of consider as well too is there are some lenders out there, especially on the AAA side, who will want you to have been in the property for at least a year before they refinance. So that's something to consider for AAA refinances. There are some B lenders out there who are okay with the lenders being, or the borrowers and the buyers being in their property for less than a year. So that's something important to consider as well too. If you have a short-term project and you want to refinance out in 5 to 6 months and you're hoping for an A refinance, it's probably not going to happen. You're probably going to be stuck with a B lender. So just be aware of that as well. So
yeah, those B lenders also will, depending on how close it is you want to exit from when you purchased, they'll probably base it off of your purchase price and not the actual value of the property, which sometimes can burn you if you're looking to pull some cash out right away. So you're either holding the loan for a year to get into an A lender, or you're going to be refinancing at the purchase price.
All right, guys. So what does it cost to refinance your property? Again, like I said, it's important to factor these into your after repair values. For it to be as accurate as possible is going to be important. You don't want any surprises come refinance where all of a sudden in your numbers, you're actually losing money on this deal or not making as much as you might need to be able to go on to project number 2. So we want to go over those costs with you. So if you are able to be able to refinance on an A lender, your fees are going to be pretty minimal. There's going to be about a $300 to $350 appraisal fee that's going to be needed. And then there's going to be the legal fees that you have to cover as well too. So we estimate those to be around $1,850. On the B side refinance, again, there's going to be an appraisal, $300 to $350. The B side, there is a 1% broker and lender fee as well. So 1% fee for both of us to keep into consideration. There will be your lawyer fees as well too. So again, $1,850 estimated on the legal side.
If, for example, you aren't able to build that equity and get out of that financing, and you have to renew your private, most private renewal fees are the exact same as getting into the loan.
Yeah.
So if you were paying 2.5% or 3%, then you're paying 2.5% or 3% as a fee again. So that's going to eat into the equity that you're trying to be growing into your property. So it's important to realize that if you guys don't get that lift and you have a 1-year term and that renewal comes up, you guys have to eat the fees again, which isn't the most fun thing in the world. So clearly defining, create the term that you need to do, make sure that you have a strategy to get it done, because those costs, unfortunately, are some of the prices we need to pay for not executing properly on our plans.
Absolutely.
Awesome. I love it, guys. Again, this information, I can only wish that it existed back in 2010 when I originally started my real estate journey. If you guys are interested in learning more from the Findlay team, I'm going to throw a link to all their contact information down in the video description below, so you guys can jump over and hit them up, because I know the moment you heard 100% financing, you stopped listening to us and you just started daydreaming. So if you need to confirm any of the facts, again, their contact information is down in the video description below.
Give us a shout.
Feel free to reach out, guys. For sure.
Thanks again to Josh and Ehren for taking the time to shoot this video. I hope you guys enjoyed this video. If you did, smash that like button, hit the subscribe button if you're new to my channel, and jump in that comment section and let us know, what other items should we cover when it comes to financing or mortgages? Let us know in that comment section down below.